This starts out talking about leases first, which we're going to talk about second. So just bear with me while I get this queued up. So at CalcBench, we started this business about 6 years ago. We're pretty intense financial analysts trying to recover from 2009, and we can't. So what we do is we look at this data all day, really all day. And so this revenue recognition topic comes up through the grapevine. We hear it from our customers, from colleagues, from friends, and we say to ourselves, okay, this is great. We believe in data. We're going to get a ton of it. Last spring, we're ready with the catcher's mitt. It's going to come. It's going to come. Doesn't show up. So companies could early adopt this standard. Very few did. People talk about Microsoft because it's a big company. They're also the first ones to do it. So yeah, all right, fine. So a couple of things. There, as you've heard before from people, there were two methods that they could choose to implement. And by the way, I'm not an accountant, and I don't pretend to be. So if I get some accounting stuff wrong, whatever. So here's a couple of things we find. One of the things in the rule that caught our interest was that you have to accelerate the recognition of deferred revenue. So we went to our list and said, give me all the deferred revenue in software that we can find. We calculated it. We found the current liabilities of the same firms, did a ratio. Like, okay, there we go. So now we know what it looks like at a sector level. We're going to move forward, and we're going to say, okay, now at a company level, let's compare that to the sector, right? So if you're out of bounds with your sector, the way most financial analysts that we know look at it, maybe there's something here. So here's a list of 10 companies, or 11 companies rather, that had ratios greater than 100% of deferred revenue to current liabilities. Maybe hot companies. Take a look. Watch what happens with them. A couple of them you've heard about. So as this standard gets adopted more, it starts showing up in the data. Here's an example from the Northrop Grumman 10K from end of January, where they actually state their revenue right there. It's just, if you can see it, it's in the top half of the slide. And then they, in the accounting standards update section, they actually tell you if they apply the full retrospective method, what the impact would be on these numbers. And so I'm not even going to talk about it. You can just read it right there, and it's in your slideshow. So you can see that, well, revenue would have gone up, but operating income actually decreased. And so the question was, is it from unbilled receivables? And then the next question is, well, is it material? Are the analysts going to care? Et cetera, et cetera. So this is what the data can do for you. We're not here to, we have our own opinions, but we're not going to share them necessarily. We're just going to give you the data and let you decide what's important. But you can do this today, primarily because a lot of this information that is available, historically, this information had been available to people through high-priced data vendors and services like that. This is all available today through machine-readable information. If you're smart enough to put a catcher's mitt on and cache this and get the computers working, you can get at it too, or you can just call us and we'll help you get at it.